another video from Creativo Solutions. You're currently watching the support videos for the British International Distance College Accounting module. I'm going to be taking you through the accounting questions for assignment number 4 in this series of videos. Visit the website for more content and resources to help you, and consider following us on Instagram and Twitter, and keep watching the YouTube channel for more support. We've completed 3 accounting assignments so far. We're now going to be looking at assignment number 4. Assignment 4 is on page 41 of your assignment pack, and when looking at question 1, we need to interpret what the focus is here. Question 1 focuses mainly on theory. We've got different sub-questions for question 1, so we're going to start with 1A. Question 1A relates to inventory. They say, inventory valuation is often described as being at the lower of cost or net realizable value. Explain the meaning of 1. Cost and 2. Net realizable value. This is theory. Cost would be the cost price of the inventory purchased. When buying stock, there will be a very specific cost price that will be applicable, and that's what we would be using to record inventory at when buying it. So we're looking at historical cost basically. We can't undo what happened in the past, so if I buy stock, that cost price is going to represent the value of inventory when purchasing it for the first time. Number 2 asks you to describe net realizable value. Here we're looking at the actual market value of the stock currently after being bought. So after having been purchased, stock, inventory may lose value. Because inventory gets old, it becomes obsolete. Let's think about something like technology. If I'm buying mobile phones to sell, those mobile phones are going to get outdated and old as technology improves. So when focusing on net realizable value, we're looking at what will the stock be worth in today's terms, taking all other factors into consideration. Meaning, if I had to sell that stock today, what would the net realizable value be? Sometimes stock can get damaged, or old, or obsolete. Meaning we're not going to actually be able to realize the full value of those goods. We might want to sell those goods at a profit by adding a markup to the cost price in order to get the selling price, and that might not always be the price that we can sell it for. So we might have to sell it at a discount perhaps, or in a worst case scenario, if those items have become very outdated, we might even have to sell those items at a loss in order to sell those stock items in order to materialize cash, in order to get cash. We don't want cash held as stock, and therefore we could consider selling it in order to improve cash flow. So there's a lot to consider here. We're just looking at the accounting, so net realizable value would be looking at the actual value in today's terms based on what we know. Is the stock damaged? Is the stock old? Is it obsolete? And that'll determine what the actual price or value of the stock is in terms of being able to sell it. Question 1B is also theory. They say, state which accounting concept is applied when inventory is valued. Well, if inventory is being valued at the lower of cost and net realizable value, we're looking at the concept of, we could say, prudence, because it would be prudent to record the stock at a, inverted commas, true value, what we actually think those items are going to be worth. For example, if I buy stock and that stock gets damaged, that stock is obviously not going to be worth the same amount as stock that's still in a good condition. So therefore we would have to, almost like writing off some of the asset in terms of inventory, in terms of value, because we're not going to realize the same amount of value because the stock has changed in terms of it having been maybe damaged or destroyed perhaps. So there are different factors to consider here, but I would definitely consider this as being prudent because we're providing for the true value of the inventory that is being held for sale. That's something to consider. Let's have a look at the next question. We're looking at 1C. Question 1C says, a trader provides the following information about his inventory at 30 November 2015. They've given you inventory codes, they've given you number of units in stock, they've given you the cost per unit, and they've given you the selling price per unit in the table. The trader had to pay carriage inwards on inventory, code number BD20. So that was for the first item that was bought according to the list that they have here, at the rate of $5 per 100 units. And in brackets they say not included in the cost per unit shown above. So that would have been an additional cost relating to inventory. Then they say calculate the total value of inventory which should appear in the trader's statement of financial position at 30 November 2015. Show your calculations. Okay, perfect. So just in terms of theory, obviously historical costs in terms of inventory, so that includes all other inventory related costs of getting the stock in a position where we can sell it. So if I'm looking at things like carriage on purchases, those things need to be included in the actual cost price of the stock that we're going to be selling because it needs to be recovered. So we don't know which system is being used here, periodic or perpetual. So I would assume that they're using maybe perpetual because then they're going to include the carriage inwards in the actual cost price of the stock. If I assumed that they were using periodic, then I would record the carriage inwards on inventory as a separate line item, but that would obviously affect the cost of sales calculation for this particular business. All I'm going to do here is record the total value of inventory as it would be disclosed in the statement of financial position at 30 November 2015, and we're going to show calculations. So first things first is obviously to identify all the different items. So stock type 1, and then the carriage on inventory or purchases, either or, inventory for stock item type 1. That's something else that we need to consider. So when focusing on stock type 1, we're looking at the value of stock. So number of units in stock. Let's create a table. Units, cost per unit, cost per unit, and we've also got selling price per unit. Let's first write down units. So units is the quantity. Units, number of stock units. Okay, so cost per unit, that's fine, and selling price per unit. Selling price per unit. If I'm looking at recording inventory in my books, I'm going to be looking at the cost price. I'm not going to be looking at the selling price unless I'm going to be selling those items at less than what they're actually worth. So if I'm looking at the number of units here, I've got 300 units of stock 1, 119 of stock 2, and 410 of stock 3. The cost per unit here is $1.50. This is 95 cents, and this is $1.78. Then you've got the expected selling price, which is $2.30 here, $2.30, 80 cents here, and 1.85 there. So looking at this, we're looking at cost. You can see that in the first situation, the cost is lower than the selling price, so we can sell it at more than what we bought it for. In the second scenario, we're actually selling, or going to be selling, this item at less than its cost price. And in the last scenario, we're going to be selling it at more. So this would be asterisk considering the net realizable value. Okay, we would have to record the stock at the lower amount of the cost or the net realizable value. So I'd be recording cost at the selling price because I'm not going to be selling it at a greater amount than the initial cost price of 0.95. So this inventory has probably become obsolete perhaps, or damaged, and therefore we can't sell it at a higher price than its current cost per unit. So let's look at the inventory in our books. Inventory in the statement of financial position. So the first thing I'm going to do is obviously take the number of units here, and I'm going to multiply that by the cost per unit. Then I'm going to take the number of units here and times it by this, the selling price, because it's lower than the cost. So it'll be 95.2. And then here I'd take the unit and I'd multiply that by the cost because it was less than the selling, so that's what I'm going to record there. Then there was carriage on inventory for stock item number 1. They said in the question that you had to pay $5 per 100 units of the first item. So the item that was labeled BD20, which was the first one. Okay, so per 100 units. So what am I going to do here? I'm going to take $5 times it by 300 units divided by 100 units equals, that would be 3 times 5 is 15. So $15 would be the carriage on inventory for those items purchased. And then I'm going to say equals, sum up all of that, and I'm going to therefore record this in the accounting books for the entity for the year ended 30 November 2015. That's what I would be representing in my answer. Question 1D. Name the accounting principle which states that only the financial transactions of the business should be recorded in the entity's books. Right, so we obviously know that the business needs to be separate from the owner. Only transactions relating to the business's operations should be recorded for the business. What's the business is the business's, so the business will record transactions only that pertain to it specifically in the actual accounting records of the entity. So if there's anything outside of the business in terms of other transactions relating to maybe the employees or the owners of the business, it wouldn't affect the business. The business is a separate entity that needs to be accounted for. Separately. Great, and now let's look at the last theory question here, which is question 1E. 1E is split into two parts. The first part gives you a bit of information. They say, today a man tells the owner of a clothing shop that he will buy a coat tomorrow. So that means a customer has come to the owner of the shop, and the customer has said, well, I'm going to buy a coat tomorrow. Question number 1 says, explain why the owner of the shop should not yet record the sale. Well, no transaction has arisen. Okay, so no transaction or took place. Let's use that. Only when transactions arise will they be recorded in the financial records of the entity. or the business. Okay, so that's what we're going to be using. Transactions have to arise. There needs to be a source document. We cannot record a transaction if there's no source document. So if someone says they're going to buy from us, well, they haven't bought from us. If they do buy from us, then we'll record the transaction in our books, because now a transaction has arisen. So now we can record it. Great. Number 2 says, state which concept you have applied in number 1. Well, if we're looking at recording transactions as and when they arise, this would be looking at, we would be, there's a few things we could maybe consider here. The first would be accurate representation or faithful representation. In terms of transactions that are only recorded when they arise. So that would be accuracy, integrity relating to the financial statements in terms of characteristics. Accuracy, integrity, and honesty. We're looking at representing information honestly, correctly. So why does the owner not record the sale, and which concept have you applied? Well, we're looking at recording things as and when they arise, not when we think someone's going to buy something. So we can't record someone's opinion. We can't do that. We need to record facts. So facts have to be recorded. Right, based on source documents. So when focusing on recording transactions, remember these transactions haven't taken place yet. So when they take place, okay, so if a transaction took place between the business and the customer, then we can record something that relates to it. So for example, if a customer bought on credit, we'll have debtors. Can I provide for a provision for bad debt or credit losses? The answer is yes, I can, because I've recorded something in the books already, meaning the transaction has already taken place. I'm just trying to be more truthful and honest to the users of the financial statements by creating a provision, because we're saying that while not everyone is going to pay us, and we expect a certain amount of the outstanding debtors to not pay, and that's why we provide a provision. So we're creating for things that can happen in the future only once we've actually recognized an actual transaction that was taking place and that was recorded in the business's books. Here we're looking at recording a man who told us that he's going to buy something tomorrow. We can't record anything. It wouldn't be right to show things that we think we're going to do in the future. If something has happened, we can then provide for provisions, but we can't provide for things that haven't even happened yet. That wouldn't be correct. And that concludes question number 1 for assignment number 4. I hope you found that helpful. Please consider subscribing to the channel and hit the thumbs up button if you like the video, and we'll keep creating more to help you.